Trading cryptocurrencies has risen in popularity over the last few years, becoming increasingly mainstream as we witness a digital gold rush of new technology and creativity. This increase in investment in digital currencies has pushed the overall market value of cryptocurrencies past $3 trillion. The speculative development of blockchain technology and its several cryptocurrencies has piqued traders' interest, who are fearful of losing out on substantial profits. This is in stark contrast to the Forex markets, where currency exchange prices seldom vary. The leverage used in Forex is what contributes to its attraction to traders. In this video, we will discuss which one is better, crypto or Forex trading. Make sure you watch until the end because it is exciting. At this point, you may be wondering, how does cryptocurrency work? Trading cryptocurrencies entails either speculating on price fluctuations, using a contract for differences trading account, or purchasing and selling the actual coins via an exchange. You may go long or buy if you believe the value of a cryptocurrency will increase, or short or sell if you believe the value will decrease. Both are leveraged instruments, which means that you only need to make a tiny initial investment, referred to as margin, in order to acquire full exposure to the underlying market. In contrast to conventional currencies, cryptocurrencies exist only as a decentralized digital ledger of ownership, which is recorded on a blockchain. When a user wishes to transmit Bitcoin to another, they do so using the recipient's digital wallet. The transaction is not considered complete until it is validated and added to the blockchain, a process known as mining. The cryptocurrency markets fluctuate in response to supply and demand. Due to their decentralized nature, they are often immune to many of the economic and political challenges associated with conventional currencies. With Instagram, you can trade cryptocurrencies using a CFD account, derivative instruments that allow you to speculate on the price movement of your selected cryptocurrency. Leverage allows you to obtain exposure to huge quantities of Bitcoin without having to pay the whole value of the deal up front. When a leveraged position is closed, the profit or loss is calculated on the entire amount of the transaction. It's critical to examine the specifics on your selected trading platform to ensure you understand the unit of measurement for price changes. Now that you know a little bit about crypto trading, it's time to understand Forex trading. Forex trading is the act of simultaneously purchasing and selling one currency while purchasing another at the same time. The euro against the US dollar and the British pound versus the euro are the most commonly traded foreign exchange pairings. Forex markets are classified into three types: spot, forward, and futures. Spot Forex is the physical exchange of currency pairs that occurs immediately after the deal is finalized, i.e. on the spot, or within a short period of time. Forex derivatives enable you to speculate on the price movement of an item without really owning it. A significant benefit of spot FX is the possibility to trade on leverage. When trading using leverage, you make a modest initial investment, referred to as a margin. When a leveraged position is closed, the profit or loss is calculated on the entire amount of the transaction. The difference between the purchase and selling prices stated for a currency pair is called the buying price. If, for example, the euro against the US dollar purchase price is 1.7645 and the selling price is 1.7649, the spread is 4 pips. A single pip is a change in a currency's second decimal place. Commercial banks and other investors regulate supply, which may be impacted by central banks. Additionally, central banks manage an economy's base interest rate, which may affect the value of its currency. So which is better, crypto or Forex trading? Let's figure it out by discussing their differences. They are different with regard to their number of available instruments. Typically, traders in Forex focus on the major currency pairings: euro and US dollar and yen, British pound and US dollar and Swiss franc, US dollar and Canadian dollar, Australian dollar and US dollar, and New Zealand dollar and US dollar. Certain traders choose to trade exotic currency pairings, which combine a major currency with the currency of a developing nation, such as South Africa or Mexico. There are already over 11,000 distinct cryptocurrencies, and the number continues to expand. While some of them, such as Bitcoin or Ethereum, are frequently traded, many others are only known to die-hard crypto fans. Crypto markets provide a diverse range of products, while FX markets may face periods of quiet trade lasting days or even weeks. Because tracking all cryptocurrencies is difficult, traders will have to choose a limited number of coins to follow. As a result, traders will continue to operate with a restricted watch list. They are different with regard to their market participants. The characteristics of these assets are not the only distinction between cryptocurrency and Forex. Additionally, who engages in these marketplaces varies. Not only private investors, but also big governmental and institutional actors participate in FX markets. Governments have a role to play, since they must guarantee markets have the necessary liquidity to meet economic objectives. On the other hand, governments are currently tiny participants in the cryptocurrency industry, despite growing interest in state-controlled cryptocurrencies. Bank and credit providers offer the majority of the market's liquidity. According to Grossbard, these players often act as liquidity providers in Forex markets as a result of the requirement to convert money on behalf of customers going or doing business abroad, as well as people investing in foreign securities markets. Investment funds may speculate or engage in Forex using their extra money or leverage. Businesses that operate in different geographic markets may utilize Forex to hedge against currency swings, therefore protecting earnings from anticipated changes in currency values. They are different in their volatility and liquidity. Due to the fact that cryptocurrency is a smaller market than Forex, smaller quantities of money can move cryptocurrency more significantly than FX. If an additional $256 billion entered the crypto market, we could theoretically anticipate all crypto values to double. The same $256 billion represents a move of around 4% in the foreign exchange market. As a consequence, the cryptocurrency market is far more volatile than the foreign exchange market. Increased volatility entails increased risk for investors, a greater possibility of both exponential growth and massive, financially debilitating losses. Increased volatility also results in decreased liquidity, ease of trading, since more individuals are naturally drawn to a tranquil market. Due to its low volatility and great liquidity, the FX market is able to absorb economic shocks more effectively. This helps the common citizen, both investor and non-investor, by ensuring that currencies remain reasonably stable even during difficult economic times. Simultaneously, an experienced investor may do fairly well on the cryptocurrency market if they do their homework and understand when to purchase and sell. They are different in terms of their profitability. The high amount of volatility in the cryptocurrency market raises the possibility for massive rewards. However, other variables such as the quantity invested can affect the earning potential. If you make a significant investment, you will get larger benefits. However, you must invest prudently and keep current on cryptocurrency trading. While the Forex market also has a high profit potential, it is more proportional to the size of the investment. They are different in terms of their regulation. The Forex market is a highly regulated industry. This asset class has existed for as long as there have been markets on which to trade, and because of its volatility and worldwide consequences, governments take a keen interest in currency traders. On the other hand, cryptocurrency remains somewhat of a Wild West. Crypto markets continue to argue that they are developing technological products that are no more regulated by the SEC than a Word document, while simultaneously promoting the advantages of investing in their cryptocurrency exchanges. Government authorities have yet to reach a consensus on any aspect of cryptocurrency regulation, and progress has slowed as the sector has become bigger. This implies that investors can join the crypto industry more readily, since there are less regulatory barriers to entry. However, it also implies that crypto is far more unpredictable in the long run. The Securities and Exchange Commission, the Internal Revenue Service, the United States Treasury, and other appropriate agencies will ultimately regulate the cryptocurrency market in the same way they regulate all other securities markets. The unusually high rate of fraud among new cryptocurrency startups almost ensures this. As a consequence, investors should trade with the knowledge that the only concern is the nature of such restrictions, not their implementation. We've seen the differences between crypto and Forex trading. Let's look now at some of the similarities. Both marketplaces are governed by the laws of supply and demand. One similarity between the crypto and Forex markets is that price movement is mostly determined by supply and demand. When demand for Bitcoin or the US dollar is high, the price will rise. Similarly, when supply exceeds demand, the price will decrease. Both methods of trading are automatable. There is software available for automating trade execution in both the Forex and cryptocurrency markets. This program may automatically establish market entry and exit points as well as stop-loss levels to help you manage your risk. A prominent cryptocurrency trading robot endorsed by Peter Jones, Bitcoin trader, claims to provide daily profits of up to 400%. Effective risk management is critical for profitability in both sectors. It is hard to predict the direction in which the cryptocurrency and foreign exchange markets will move with each deal you enter. That is why both types of trading need a firm grasp of risk management in order to be profitable. You may have good fundamental and technical analytical skills, but without stop losses to safeguard your positions, you risk suffering losses significantly higher than your initial investment if markets do not behave as expected. In conclusion, trading crypto offers a far higher potential for profit, and a few individuals have earned billions of dollars doing it. There is tremendous potential to profit from the continual influx of initial coin offerings. So if your goal is to make as much money possible, then crypto trading is best. However, if you feel more comfortable making extra money in a slower, safer way, then Forex trading would be your best option. Which of these two methods of trading is most attractive to you? What else would you like us to talk about in our upcoming videos? Let us know in the comments below, and make sure to subscribe and turn on notifications so you don't miss out on any of our videos.